Hey, what's up, everybody? Welcome back to Investing Sucks. So in this video, I'm going to be doing a back test of another investing strategy. And I got some pretty good feedback on the last video where I did this. And I think a lot of people seemed pretty intrigued by the idea of doing back tests on certain investing strategies or on certain types of companies. So I think in the future, I'll be doing more of these types of videos. And now that I've got the scripting functionality working pretty well in my website, Tickernomics here, really the only limit will be our own creativity. So what this video is going to be is a back test of whether the companies that have the strongest brands tend to outperform the market over the long term. And I think this should be interesting because usually companies with strong brands we associate with things like market leadership in their respective industries, or specifically we'll say they have an economic moat because of how strong their brand is, right? That's a very common term that value investors like to use, and it's usually used under the assumption that companies that have that quality are some of the best companies that you can invest in. And as such, you would expect those companies to outperform the market in the long run. And having a strong brand is one potential source of a economic moat that a company could have. Now, the way I'll objectively determine what brands are the best brands in the world is by using Forbes magazine's list of the most valuable brands in the world. So this is a list that Forbes publishes every year, and I can only assume they've been consistent in over the years of how they've determined what brands are the most valuable. And if we go over here, they actually outline their methodology in determining which brands they consider to be the most valuable. So they look at specifically brands that have a strong presence in the US. And then they also look at the 3-year average of earnings before interest and taxes, which to me, using earnings before interest and taxes does make a lot of sense because you want to strip out the effects of interest rates and tax rates that can have on a company because that's really something that's outside of the company's control. I mean, to a degree, they can control what their interest rates are because they can have a better credit rating, but taxes aren't something that they can really control because those are just going to change depending on what jurisdiction they're in. So to me, doing that makes sense. They also subtract a earnings charge of 8% of the brand's capital employed. And the logic behind that is they figure that a generic brand, so a company that basically has no brand power, should be able to earn at least 8% on its capital, which is a little subjective, but that's what they do. And then they allocate a percentage of those earnings to basically to the brand itself, based on the brand that whatever role the brand plays in that company's industry. And that part does strike me as a little subjective because maybe they have some further methodology in how they determine that, but really determining how much of a company's earnings are attributable to just the brand seems like a pretty difficult task. But Forbes is very reputable, so I do feel comfortable using their methodology as a way of determining which companies are the strongest brands. And if we take a look at the actual list, this is the 2020 list, then I don't think anyone would really disagree that these companies are the strongest ones. If you look at the top 5, we got Apple, Google, Microsoft, Amazon, Facebook, all companies in the technology space. And these are companies that I'm sure everyone would agree are fantastic companies, right? They're great companies. They have a great track record, many years of growing earnings, sales, free cash flow, high returns on invested capital, all those sorts of things that would lead you to think that these are the best companies in the world. So the problem is exactly that. Everyone knows that these are great companies. So if everyone knows that, then they're going to be priced, their stock prices are going to be priced to reflect the excellence that they have, right? And the way you're going to outperform the market is by buying undervalued companies. And it's pretty unlikely that a company that everyone thinks is fantastic is going to be undervalued. So that's kind of my hypothesis for this, is the fact that everyone knows these are great companies. So maybe it's unlikely that these companies will actually outperform the market, and maybe they even underperform the market, which would be counterintuitive to what the average investor probably thinks. Because usually when people are getting into investing, they don't really see the disconnect that can happen between stock price and actual value of the company. Usually they say if a company is growing its sales, then its stock price must also be growing in tandem with that, which as seasoned investors, you learn that that's not necessarily always true. And they'd probably think that, well, the best companies in the world like Apple, surely these must be great investments. So let's let the back test actually prove if that's the case or not. So in order to actually do this back test, what we're going to need is a way of calculating stock price performance for each of these companies, but also take into consideration the fact that some of these companies pay dividends. And I wanted to measure total stock price performance. So not just the change or the increase or decrease in the stock price, but also the dividends that you would have received if the company does pay dividends, and what if you had reinvested those dividends back into the company. So that's what I'm going to look at specifically in the total return. So what I did here was I created a script that basically does that. So it's called a dividend reinvesting here, and I'll make sure that I publish this script so anyone who uses this website here, which I'll leave a link into the description, can also use this script for whatever companies they want to look at. But basically how it works is you enter the ticker symbol. So I could enter a ticker like Apple, and then you enter a holding period. So this is how many years back you want to backtest. So if I want to go 5 years back, I'll enter the number 5, and then just a amount invested. So I could enter, say, $1 million here. I think that's $1 million. Yeah. One less zero. There we go. And then just hit run. And it's going to take a few seconds, but then it's going to generate some results in here, which are these lines here. So what you'll see is all these numbers, which is, so this number here would be the amount of shares you would have initially acquired if you invested $1 million into Apple 5 years ago. And then this along the way is the shares that you're receiving from dividend reinvesting. And then it's basically saying you would have turned $1 million into about $4.6 million, which is an annual return of about 35.6% over 5 years. So that's a pretty solid return. So this is what I use to calculate stock price performance for companies that were on the website. There are a few European companies where I had to look to different sources. Now, for anyone who's new to this channel, this website here is a website that I created. It's called Tickernomics. It's a website that I'm currently working on, and I definitely recommend checking it out and trying some of the features. It has every company that's on the New York Stock Exchange, the NASDAQ, and also the Toronto Stock Exchange, so Canadian companies as well. And it's got features like you can look at 10 years of financial statement data. There's also a DCF tool, so if you want to say value a company, you can enter it here, and then it allows you to enter your assumptions to actually value the company, and plenty of other features as well. Also, there's obviously the scripting, which is something that I'm working on as well. And right now I'm just looking to get some feedback to improve the website. So if you are willing to do that, I would greatly appreciate it. Okay, so now that we've got the hypothesis and the methodology covered, let's dive into the actual results. So what I did here was I ran two back tests. One was as of 5 years back, so September of 2017, and the other was 10 years back, so September of 2012. And 2012 is about as far back as I can go because currently there's 10 years of financial statement data loaded onto Tickernomics, and also the Forbes list was first came out in 2010 or 2011, I believe. So I can't go 20 years back just because I don't have the data that allows me to do that. And I'm also going to assume that you would have invested in these companies at market cap weights. So that's a key thing. So larger companies are going to receive proportionally larger investments, and there's also going to be no rebalancing. It's just your initial investment is going to be allocated dependent on the company's market caps 5-10 years ago. So this is as of 2017. These are the top 10 companies here. And as we saw from the 2020 list, Apple was number one. And 5 years back in 2017, Apple was still number one. And the list actually looks pretty similar back then as it did to now. We still have some of the same companies at the top, like Google, Microsoft. Amazon is a bit higher today than it was back then. And you can see Toyota was number 8 here. But let's say you had $1 million and you invested in them at market cap weights 5 years ago in these companies here. So how would you have done? So basically what I have here is I have the total amount of, so the sum of all the market caps, a percentage allocated, and then what the 5-year return was for those companies. And you can see pretty much on all of the companies, you would have performed pretty well. The only one where you would have lost money is actually Facebook, which Facebook doesn't pay any dividends either. I guess it's called Meta now. But that's the only one where you would have lost. Now, there were some companies that underperformed. For example, Disney didn't have great stock price performance, but still pretty good overall. But the total return on the portfolio was just under 22% compounded annually over the past 5 years, which the S&P 500, which is what I'll use as the benchmark for the market, was about 11.5 to 12%. So you definitely would have outperformed the market investing in these companies. Now, I know there's some people are going to say that we're like, well, yeah, obviously. I mean, look at the companies you're investing in. I mean, it doesn't really take a genius to figure out that if you had bought Apple or put most of your portfolio in Apple, Google, Microsoft, Amazon, that you would have outperformed the market. I mean, those companies have done extremely well, as we can see from the results here. You know, Apple was the best performer, 35% compounded. Samsung pretty good as well, which was number 10 on the list. You can see Microsoft did pretty good as well, and most of these companies like did outperform the market from what I can tell at least. So what I also wanted to do was look at the companies that were listed 11 through 20 on the list as of 2017, because remember, we're comparing it to the S&P 500, right? The S&P 500 is 500 companies. These are just 20 companies that are supposedly some of the best companies that you can buy on the S&P 500, even though some companies like Mercedes-Benz, Louis Vuitton aren't. I don't believe they're on the S&P 500 because these are European companies, but the vast majority are S&P 500 companies. And because they have the best brands, you'd assume that they would outperform the market, right? And these are the 20 of supposedly the best companies, right? So if we're comparing the 20 best companies to the 500, including the S&P 500, then you would still expect these companies to outperform, even though they're not in the top 10. So how did the results look for these companies? Well, it was worse, and you actually underperformed the market in these companies. So the worst one, really what led to such bad performance, was General Electric, because this was number 11 on the list at the time, and you would have allocated a big chunk of your portfolio into them, and they haven't done great over the last 5 years. But even other than that, I mean, the S&P 500 did 11.5, 12%. There were only a few companies that actually beat that. You can see Cisco beat that, Nike beat that, and LVMH, which is Louis Vuitton, beat that, which again, that's a European company. So pretty interesting find there that the companies in the top 10 outperformed the market, but the companies 11 through 20 didn't. So let's actually take it one step further now and let's go 10 years back. So this is as of 2012, September 2012. And as we can see, Apple is still number one. So Apple's been number one on this list for over a decade now. And it does look kind of similar. You still got Microsoft up there, and Coca-Cola was number three. But what I found interesting was IBM at number four, ahead of a company like Google, which, I mean, if you can imagine, things were different in 2010, obviously, but imagine if you were thinking about, okay, whether I should invest in IBM or invest in Google, and one of the things you used to determine was, well, IBM has a stronger brand according to this, so maybe I'll invest in them, which, you would have gotten vastly different investment results from that. But let's see how this did. Again, we'll split them up, companies listed 1 through 10 and companies listed 11 through 20. So over the last 10 years, the S&P 500 has done about 14, 14.5, 15%. It depends like what time or what point in time you invest in them. But you still would have outperformed the market with the companies that are listed 1 through 10. And it's kind of for a similar reason as before, is that it's very top heavy for certain companies that we know did well. Like Apple, we know for a fact that Apple has outperformed the market over the last 10 years, and their 10-year compounded annual return is just under 30%. And the 10-year return for Microsoft is basically the exact same, just under 30%. And there was one company, again, we can see here, General Electric, which didn't have great results over that time. IBM didn't really have great results, and you can see clearly they underperformed Google by a significant margin. I mean, 4.6 versus 20% compounded over 10 years, that is a huge difference. But these companies did. If you bought a market cap weighted basket of these companies, you would have outperformed the market. And again, that's assuming no rebalancing either. But if we look at companies 11 through 20, which include these companies here, so we have Oracle, Samsung, Disney, Toyota, HP, Mercedes, which some of these companies I had to use their parent companies because they got acquired over the years. Like Gillette was a company that's now owned by Procter and Gamble, so I just substituted them for Procter and Gamble's 10-year performance. Nescafe is now owned by Nestle, so I did the same thing there, which, I mean, the parent companies, if you assume that they own these companies, there's probably a reason that they bought them. So to me, it makes sense to use them as a proxy for that, especially because these are still strong brands in and of themselves. Like Procter and Gamble, Nestle are very, large companies. But you would have underperformed the market with the companies 11 through 20 once again. And not by a lot, though. I mean, you would have had a total portfolio return, again, if you had invested in just these companies at market cap weights of 12, just over 12%, but that did underperform the S&P 500. So to me, I find this interesting because kind of like my hypothesis, it was we would expect the companies with the strongest brands to produce the best investment results. And that's maybe a justification that people use for investing in these companies is, well, they're the strongest brands, right? Everyone loves these brands. Everyone is buying for them for a reason. How could they not outperform the market? How could these companies not do well? And, the results are very telling that it is possible that this is just maybe a blip in the fact that companies like Apple are included in here, that they just did exceptionally well. that's kind of skewing the results. But if we look at these companies here, I mean, I would have expected these companies to outperform based on their brand power, but they have actually underperformed the market. Okay, so now that we've gone through the results, I do want to mention a few caveats to this back test I did, because I know this isn't a perfect back test and I can already hear people typing out their comments. I can hear the keyboards clicking in the background, so just hold your horses and let me explain a few things first. So like I kind of just recently said, it's certainly possible that what we just looked at here is an anomaly and it's not actually indicative of future investment results. So please don't interpret this as investment advice and how you should just now go out and look at the Forbes list of the top 10 companies and just invest in a market cap weighted index of those companies, right? The focus of this video was more on the justification that people make for investing in a company, not just a company in the top 10 or top 20, but just investing in a company in general on the basis of their brand alone, saying that they have a strong brand that leads them to have an economic moat, which means because of that, I think that they're going to outperform into the long run, right? Because as we can see from the results here, it's true for some companies, but it's not true for other companies. So it's not really a reliable investing strategy. And I do find it at least a little telling that the companies listed 11 through 20 underperformed the market, right? Because these are, like I've said many times now, supposedly the best companies in the world that you can invest in. And it is kind of unfortunate that Forbes has only been doing this list for about 12 years now, because I think it would have been interesting to backtest this if I could go back to the 1980s or the 1990s. But you also have to consider that these things tend to work in cycles, because as we saw here, capitalism is a brutal game, right? Companies come and they go, and some companies succeed and then they fail. IBM was the fourth strongest brand as of 2012, ahead of companies like Google. And I don't even see Amazon on this list anywhere. Ahead of companies that we know have done well, like I guess Samsung has probably done pretty well. But at the time, IBM was a strong company, right? And if you were to ask someone who's looking at this list in 2012, like, would you invest in IBM or Google? Of course, it's obvious to us now because we know how the results played out. But it wasn't obvious at the time, right? It wasn't obvious that Google was going to become what it's become, and IBM was going to, not really pan out into much as they are today. So yeah, those are the main limitations, really just a lack of, a breadth of historical data that allows us to test this for say 20, 30 years. But we were able to do 5 and 10 years, which to me, that is what I would consider a long-term time horizon in investing. Of course, things could fluctuate in those time periods. And like I said, these things do work in cycles. So it is also possible that maybe this was just an anomaly for the 10 years we looked at. And if we were to do this in 1990, the strongest brands back then would not have outperformed the market 1990 to the year 2000. That's a possibility as well. But, I did the most with what I had here, and I think it did reveal pretty telling insights, which is that companies that are strong brands, that shouldn't be the only justification you have for investing in them. You should be looking at other things, take into consideration context, the industry, and actually have a more solid basis for your belief that that company will outperform the market if that is what you think will happen. But anyways, guys, thank you so much for sticking around and listening to this video. I hope you did find it useful. If you did, then please leave a like on this video and subscribe if you're new to my channel and you enjoy this type of content. And I'll see you guys in the next video.